Chapter 18, Integrated Audits of Public Companies. The Sarbanes-Oxley Act of 2002 requires that in addition to reporting upon financial statements, auditors of public companies should also report upon internal controls over financial reporting. Consistently, Pcaob Standard Number 5 recognizes this relationship and states that the internal control and financial statement audits should be viewed as integrated. Section 404 of the Sarbanes-Oxley Act is composed of two distinct sections. Section 404A, which applies to all public companies, requires that each annual report filed with the Securities and Exchange Commission include an internal control report prepared by management in which management acknowledges its responsibility for establishing and maintaining adequate internal control and provides an assessment of internal control effectiveness as of the end of the most recent fiscal year. Section 404B, which applies to public companies with a market capitalization in excess of $75 million, requires the CPA firm to audit internal control and express an opinion on the effectiveness of internal control. Management has always been responsible for maintaining effective internal control. However, the Sarbanes-Oxley Act of 2002 increases management's responsibility for demonstrating that controls are effective. As operationalized by the SEC, management is required to accept responsibility for the effectiveness of internal control, evaluate the effectiveness of internal control using suitable control criteria, support the evaluation with sufficient evidence, and provide a report on internal control. Management's report and the auditor's opinion must be included in Form 10-K, the annual report filed with the SEC. The Sarbanes-Oxley Act requires management to perform the required steps in a meaningful manner to support its report. While the exact wording of the report is left to management's discretion, Section 404A of the Act requires the report to state that it is management's responsibility to establish and maintain adequate internal control, identify management's framework for evaluating internal control, include management's assessment of the effectiveness of the company's internal control over financial reporting as of the end of the most recent fiscal period, including a statement as to whether internal control over financial reporting is effective, and include a statement that the company's auditors have issued an audit report on management's assessment. For most SEC registrants, passage of the Sarbanes-Oxley Act resulted in a one-time major project for evaluating and improving internal control to allow both management and the auditors to conclude that the company's internal control was effective. The project was performed either by the company itself or by the company assisted by consultants, often personnel from a CPA firm that does not audit the company's financial statements. The management must first understand the definition given for internal control by Sarbanes-Oxley and then conduct the evaluation using an accepted control framework such as Internal Control Integrated Framework created by the Committee of Sponsoring Organizations of the Treadway Commission, known as COSO. To perform its evaluation and make its assessment, management must understand the concepts of control deficiency, significant deficiency, and material weakness. Management's report on internal controls must be based on the Pcaob definition of internal control and must result from an evaluation using an accepted control framework. Although not required, the control framework ordinarily used is the Internal Control Integrated Framework created by COSO. The components of internal control per the COSO framework are shown in this slide. It is important to note that the evaluation is limited to the controls over financial reporting and therefore will not include all components of the company's internal control system. A control deficiency exists when the design or operation of a control does not allow management or employees in the normal course of performing their functions to prevent or detect misstatements on a timely basis. A significant deficiency is a control deficiency or a combination of control deficiencies in internal control over financial reporting that is less severe than a material weakness, yet important enough to merit attention by those responsible for oversight of the company's financial reporting. A material weakness is a control deficiency or combination of control deficiencies in internal control over financial reporting, such that there is a reasonable possibility that a material misstatement of the company's annual or interim financial statements will not be prevented or detected on a timely basis. This slide compares control deficiencies, significant deficiencies, and material weaknesses and the effect of each on management's assessment and the auditor's report. A control deficiency and a significant deficiency do not result in a modification of the reports. Only a material weakness results in a modification, and that modification will be an adverse opinion. This is different from reports on audits of financial statements. In an audit of financial statements, a departure from generally accepted accounting principles results in either a qualified opinion or an adverse opinion based on materiality. Scope limitations may result in either a disclaimer or withdrawal from the engagement, depending on the extent of the limitation. The overall objective of management's evaluation of internal control is to provide it with a reasonable basis for its annual assessment as to whether there are any material weaknesses in internal control as of the end of the fiscal year. How does management go about achieving this objective? The SEC guidance is structured about two broad principles. First, evaluating the design of controls to identify controls and risk, and two, evaluating the operation of the controls. This is consistent with the internal controls coverage throughout the text. First, consider the design and then the operating effectiveness of controls. A required part of management's evaluation process is appropriate documentation of internal control. Then management's evaluation process culminates with the issuance of management's report on internal control, which include management's assessment. If management believes that no material weaknesses exist at year end, it is able to issue a report concluding that the company maintained effective internal control over financial reporting. The auditor's objective in an audit of internal control is to express an opinion on the company's internal control over financial reporting. To meet this objective, the auditors must plan and perform the audit to obtain reasonable assurance about whether material weaknesses exist as of the date specified in management's assessment. Evidence is gathered on both the design and operating effectiveness of internal control as of the date specified in management's assessment, which is normally the last day of the company's fiscal year. This slide illustrates the steps in an audit of internal control over financial reporting. Each of these steps will be considered in detail in the following slides. Auditors first plan the engagement. Efficient planning requires coordination with the financial statement audit. For purposes of both audits, the auditors consider matters related to the client's industry, regulatory matters, the client's business, and any recent changes in the client's operations. The auditor's knowledge of a client's internal control at the planning stage of the engagement will differ significantly depending upon the nature of the client and the auditor's experience with that client, and this in turn will affect the scope of the auditor's procedures. For example, when the auditors had previously performed audits of the client, the auditors begin the integrated audit with more information than in a circumstance in which the company is a new audit client. Accordingly, they only have to perform procedures to update their knowledge. There is a subtle difference between the auditor's consideration of internal control for the audit of internal controls as compared to their consideration of internal control in an audit of financial statements. In the audit of internal control, the focus is on whether internal control is effective at a point in time, the as-of date, which is ordinarily the last day of the client's fiscal period. By itself, this would involve performing tests of controls for a period that is usually significantly less than the entire year. On the other hand, in a financial statement audit, the consideration of internal control is performed to help plan the audit and to assess control risk for the entire financial statement period. Therefore, the auditors must perform tests of controls of transactions occurring throughout the year to meet the objective of obtaining sufficient evidence to support the opinion on internal control and assess control risk. When planning and performing the audit of internal control, the auditors should also recognize internal control differences between small and large clients. Often these differences are related to the degree of complexity of their operations. The goal of the top-down approach is to focus on testing those controls that are most important to the auditor's conclusion on internal control while avoiding those that are less important. Entity-level controls are often those included in the control environment or monitoring components of internal control. For example, the portions of the control environment dealing with integrity and ethical values, oversight by the board of directors, and appropriate assignment of authority and responsibility have a pervasive effect on internal control. Entity-level controls relating to audit committee effectiveness, fraud, and the period-end financial reporting process are particularly emphasized in Standard Number 5. The audit committee is particularly important since an effective audit committee exercises oversight responsibility over both financial reporting and internal control. In considering entity-level controls, the auditors should be aware that controls may have an indirect or direct effect on the likelihood of misstatement. This figure illustrates the top-down approach, which starts at the top of the financial statements and entity-level controls and links the financial statement elements and entity-level controls to significant accounts, relevant assertions, and to the major classes of transactions. Next, the auditors should obtain an understanding of significant accounts and disclosures. Then the auditor must determine which financial statement assertions are relevant to the significant accounts. Last, the auditor should understand the flow of transactions related to the relevant assertions to allow them to identify points within the company's processes where a material misstatement could arise and to identify the controls to prevent or detect these misstatements. This figure lists some of the entity-level anti-fraud controls with examples of conditions that would indicate that there is a significant deficiency in internal controls. An account is significant if there is a reasonable possibility that it could contain a misstatement that individually or when aggregated with others has a material effect on the financial statements, considering both the risk of understatement and overstatement. The assessment should be made without giving any consideration to the effectiveness of internal control. Factors that the auditors consider in deciding whether an account is significant include size and composition, susceptibility of loss due to errors or fraud, volume of activity, complexity and homogeneity of individual transactions, nature of the account, accounting and reporting complexity, exposure to losses, possibility of significant contingent liabilities, existence of related party transactions, and changes from the prior period. Relevant assertions for an account are those that have a meaningful bearing on whether the account is presented fairly. For example, valuation may be very relevant to determining the amount of receivables, but it is not ordinarily relevant to cash unless currency translation is involved. The major assertions for accounts are existence or occurrence, completeness, valuation or allocation, rights and obligations, and/or presentation and disclosure. Although not explicitly stated in Pcaob Standard Number 5, it is helpful to classify transactions by transaction type, routine, non-routine, or accounting estimates. Routine transactions are for recurring activities such as sales, purchases, cash receipts and disbursements, and payroll. Non-routine transactions occur only periodically. They are generally not a part of the routine flow of transactions and include transactions such as counting and pricing inventory, calculating depreciation expense, or determining prepaid expenses. Accounting estimates are activities involving management's judgments or assumptions, such as determining the allowance for doubtful accounts, estimating warranty reserves, and assessing assets for impairment. While not required, performing walkthroughs may frequently be the most effective way to obtain an understanding of the likely sources of misstatement. A walkthrough involves literally tracing a transaction from its origination through the company's information system until it is reflected in the company's financial reports. Walkthroughs provide the auditors with evidence to verify that they have identified points at which a significant risk of misstatement to a relevant assertion exists. Verify their understanding of the design of controls, including those related to the prevention or detection of fraud, evaluate the effectiveness of the design of controls, and confirm whether the controls have been placed in operation or implemented. To understand the likely sources of potential misstatements and as a part of selecting the controls to test, the auditor should understand the flow of transactions, verify points within the company's processes at which a misstatement could arise that could be material, identify the controls management has implemented to address these potential misstatements, and identify the controls management has implemented to prevent or detect on a timely basis unauthorized acquisition, use, or disposal of the company's assets that could result in a material misstatement. The auditor should test those controls that are important to their conclusion about whether the company's controls sufficiently address the risk of misstatement for each relevant assertion. It is not necessary to design tests of all controls. For example, tests of redundant controls, those that duplicate other controls, need not be designed when tests of the related control are planned unless redundancy itself is a control objective. The auditor may decide to design tests of preventive controls, detective controls, or a combination of both. Preventive controls have the objective of preventing errors or fraud from occurring. Detective controls have the objective of detecting errors or fraud that have already occurred. Some controls are complementary controls in that they work together to achieve a particular control objective. When tests are being performed related to that control objective, the complementary controls should be tested. Tests of the operating effectiveness of a control determine whether the control functions as designed and whether the person performing the control possesses the necessary authority and qualifications. In deciding how to design tests of operating effectiveness, the auditors must focus on the nature, timing, and extent of the test. Tests of controls in the order of increasing persuasiveness include a combination of inquiries of appropriate personnel, inspection of relevant documents, observation of the company's operations, and reperformance of the application of controls. Pcaob Standard Number 5 states that the auditors should vary the exact test performed when possible to introduce unpredictability into the audit process. Tests of controls should be performed over a period of time sufficient to determine whether, as of the date specified in management's report, the controls were operating effectively. For controls that operate only periodically, it may be necessary to wait until after the date of management's report to test them. The auditor's test can only be performed at the time the controls are operating. Pcaob Standard Number 5 requires the auditors to obtain sufficient evidence about the effectiveness of controls for all relevant assertions related to all significant accounts. Generally, the more frequently controls operate, the more auditors should test them, and controls that are relatively more important should be tested more extensively. This chart indicates the suggested number of items to test for a control based on the frequency of the control, how often the control is performed. Are the tests of controls performed for an internal control audit the same as those performed for a financial statement audit? May the evidence from tests performed for an internal control audit be used for the financial statement audit? While the answer to both of these questions is yes, the auditors should consider the differences in the objectives of the test. The objective of test of controls in an audit of internal control is to obtain evidence about the effectiveness of controls to support the auditor's opinion on whether management's assessment of the effectiveness of internal control, taken as a whole, is fairly stated as of a point in time. The objective of test of controls for a financial statement audit is to assess control risk. If the auditors decide to assess control risk at less than the maximum, they are required to obtain evidence that the relevant controls operated effectively during the entire period upon which they plan to place reliance on those controls. The objectives for the two different approaches can be reconciled in the integrated audit. Pcaob Standard Number 5, for purposes of the internal control audit, allows the auditors to obtain evidence about operating effectiveness at different times throughout the year, provided that the auditors update those tests or obtain evidence that the controls still operated effectively at the end of the year. Thus, although the timing for issuing the internal control report will not ordinarily require tests from throughout the year, the integrated nature of the two audits suggests that testing should be spread throughout the year. Auditors have traditionally relied primarily or completely on evidence from substantive procedures rather than testing controls in audit areas when a substantive approach was considered the most cost-effective approach. Since auditors must now report on the effectiveness of internal control, approaches limiting the testing of controls are not acceptable. Since an integrated audit requires test of controls for all major accounts and relevant assertions, circumstances in which controls are found to be effective will lead to a decreased scope of substantive procedures as compared to a situation in which tests of controls have revealed an ineffective system or a system in which controls have not been performed. However, when significant deficiencies or material weaknesses have been identified, the auditor should obtain assurance that such deficiencies have not resulted in undetected material misstatements. Regardless of the assessed level of control risk, the auditors must perform substantive procedures for all relevant assertions related to all significant accounts and disclosures. We have discussed how the audit of internal control may affect the scope of substantive procedures performed for the financial statement audit. Alternatively, the results of substantive procedures may affect the audit of internal control. The findings obtained while performing substantive procedures in the financial statement audit may provide evidence of the effectiveness or ineffectiveness of internal control over financial reporting. For example, identification of a material misstatement in the financial statements is considered indicative of at least a significant deficiency in internal control. Additional examples of substantive procedure findings that might affect the internal control audit are those relating to illegal acts, related party transactions, the reasonableness of accounting estimates, and the client's overall selection of accounting principles. In forming an opinion on internal control over financial reporting, the auditors evaluate all evidence, including the result of their evaluation of the design, the results of testing of the operating effectiveness of controls, negative results of substantive procedures performed during the financial statement audit, and any identified control deficiencies. This slide shows the first two sections of the report of independent registered public accounting firm for a standard unqualified opinion on internal control over financial reporting. The report is addressed to the Audit Committee and stockholders of the company. The first section is the opinion on internal control over financial reporting and states that the opinion at the as-of date and the framework that the opinion was based on, in this case the Internal Control Integrated Framework issued by the Committee of Sponsoring Organizations of the Treadway Commission, or COSO for short. The last part of this section also presents the audit opinion issued for the financial statements. The second section indicates the basis for the opinion, which states that it is management's responsibility to maintain effective internal controls over financial reporting and the auditor's responsibility to express an opinion on the internal controls. The report states that the audit was conducted in accordance with Pcaob standards and includes the procedures that were used. This section ends with a statement that the auditors believe that the audit provides a reasonable basis for their opinion. The last section provides a definition of and limitations of internal controls over financial reporting. The internal controls pertain to the maintenance of records that will provide reasonable assurance that transactions are recorded as necessary to permit preparation of the financial statements in accordance with generally accepted accounting principles. This section ends with a statement that there are inherent limitations and therefore internal controls may not prevent or detect misstatements. Also, it is not possible to project any evaluation of effectiveness to future periods as the controls may become inadequate or deteriorate over time. The report ends with the signature and location of the firm and date. This slide lists the circumstances affecting the auditor's opinion on internal control. If even one material weakness exists, an adverse opinion is issued. If a material weakness existed during the year, but the system was changed prior to the as-of date, then if the auditors can test the new system and determine that the material weakness was eliminated at the as-of date, the auditors can issue an unqualified opinion. If the auditors do not have sufficient time to test the new system, then the auditors will treat the situation as a scope limitation and issue a disclaimer of opinion on internal control. If a restriction on the scope of the audit is imposed by the circumstances, the auditors should withdraw from the engagement or disclaim an opinion. If management does not disclose a material weakness properly, the auditors should modify their report to include an explanatory paragraph describing the reasons for this determination. Note that the auditor's report is already adverse due to the existence of a material weakness. Other issues may result in an explanatory paragraph, but an unqualified opinion can still be issued. Pcaob AS 2201 allows auditors to either issue separate reports on their audits of the financial statements and internal control or issue one combined report. If the report includes both, then the components of both of the separate reports are included and the section heading for the first section is changed to Opinions on the Financial Statements and Internal Control over Financial Reporting. The second section, Basis of Opinion, includes the audit procedures for both the financial statement and the internal control audits. The third section is the definition and limitations of internal control over financial reporting and includes the critical audit matters, if applicable, followed by the signature and location of the firm and the date. Pcaob Standard Number 5 requires that auditors communicate in writing to management all control deficiencies regardless of their severity. That includes material weaknesses, significant deficiencies, and other deficiencies. In addition, a written communication to the Audit Committee must be issued that includes material weaknesses, significant deficiencies, and an indication that all deficiencies have been communicated to management. The written communication on material weaknesses to both management and the Audit Committee should be made prior to issuance of the audit report on internal control. In addition, when the auditors conclude that the oversight of the company's external financial reporting and internal control over financial reporting is ineffective, they must communicate that conclusion in writing to the Board of Directors. After the existence of a material weakness has led to an adverse opinion in an internal control audit report, the company is ordinarily motivated to eliminate the weakness as quickly as is reasonably possible. When management believes that the material weakness has been eliminated, the auditors may be engaged to report on whether the material weakness continues to exist. Pcaob Standards Number 4, reporting on whether a previously reported material weakness continues to exist, provides the guidance for such engagements. To engage the auditors to perform this service, management must first gather sufficient evidence to demonstrate that the material weakness has been eliminated. document this evidence, and provide a written assertion stating that the material weakness no longer exists. The auditors then plan and perform an engagement that focuses on controls that are relevant to the particular weakness. And this is the end of the presentation for Chapter 8.